All right, welcome to the Explainer. Today we're diving into a financial theory that's been making some serious waves online. The claim? That a massive crisis is brewing in the silver market, one that could shake the entire global financial system to its core. So let's break down the source material behind this theory, one slide at a time.
So, the source material kicks things off with this really dramatic image, right? While everything looks calm on the surface, it claims that behind the closed doors of the world's biggest financial institutions, there's absolute chaos. So, what's really going on here? Okay, so let's jump right in. The whole theory starts with this idea that some very urgent, very secret meetings are happening right now. We're talking about the top financial leaders on the planet, and these aren't your typical quarterly reviews. No, these are the kind of meetings that only happen when the entire system is teetering on the brink.
So what could possibly trigger this kind of panic? Well, according to the source, it's not some super complex derivative or another housing bubble. Nope, it's a sudden, wild move in one of the oldest and most fundamental commodities out there, silver. You know, the metal that's been considered real money for thousands of years.
Yeah, a 10% jump. In a single day. The source argues that this isn't just a big market move. It's what they call a solvency event. Think of it like a shockwave so powerful it completely shatters the risk models of the big banks, pushing them right to the edge of collapse.
And the biggest danger here, according to this theory, is the threat to the clearinghouse. You got to understand, the clearinghouse is basically the backbone of the market. It guarantees every single trade. So if a huge bank goes under because of a bad bet on silver, the clearinghouse is on the hook to pay up. And if it can't pay, the whole system just freezes.
Okay, so you're probably wondering, how can one commodity price spike threaten to take down global banks? Well, the source points to one specific tool that it calls a financial weapon of mass destruction, and that's leverage. Leverage, in simple terms, is just using borrowed money to make bigger bets. It's like, imagine you're using a giant lever to lift a heavy rock. It amplifies your strength, right? But what happens if that rock slips? That same lever is going to make the impact way, way worse. And that's the danger. When the market moves against you, like the source says it has with silver, leverage multiplies your losses at a terrifying speed.
And look at this. The math here is just chillingly simple. The source lays it out like this. Say a bank is short silver, meaning they've bet the price will fall, and they're using just 10-to-1 leverage. If the price of silver goes up by just 10%, boom, their entire investment is gone. Wiped out. They're insolvent.
And here's the thing. The source makes it clear that these emergency weekend meetings, they're not new. Not at all. It draws a direct line from what's supposedly happening now, all the way back to the Hunt Brothers silver squeeze in 1980, the long-term capital management collapse in 98, and of course the Bear Stearns bailout in 2008. See, in every single one of those past crises, regulators got together over a weekend to basically change the rules and stop a total meltdown. And that brings us to today. The source claims that facing this exact kind of threat, the powers that be are digging into their emergency playbook, and they're probably debating right now which drastic move to make. So what's in that playbook? Well, the source says they've got three main weapons in their arsenal. First, they can jack up margin requirements to 100% cash, which basically kills off speculation. Second, they can force position limits, making the big players sell off their silver. Or, and this is the nuclear option, they can go into liquidation-only mode, literally turning off the buy button. But here's the catch, and this is a really key point in the theory. The source argues that in today's global market, every single one of those tools is flawed. Raising margins doesn't stop huge cash buyers. Position limits, the money just flows over to exchanges in Shanghai or London. And turning off the buy button, well, that would completely destroy the reputation of the US markets, basically handing leadership over to their rivals on a silver platter. The source really sums up this dilemma with a powerful metaphor. It's like they're trying to put out a fire with dynamite. Every move they make to save the paper market just makes the underlying problem worse, and it could actually speed up the rush out of the very system they're trying to save. And that brings us right to the heart of this entire theory, this fundamental clash between two very different silver markets.
You see, on one side, you've got the paper market, like the COMEX Futures Exchange in New York. This is where the rules can be bent, where banks have a lot of influence. But on the other side, you've got the physical market. We're talking actual coins, actual bars all over the world. And that market is driven by real supply and demand. It's much harder to control.
And this sets up what the source calls the doom loop. Think about it. To save the banks from their bad silver bets, the Fed might have to print a ton of money.
But what happens when you print more money? It makes the currency worth less, which makes hard, tangible assets like silver even more attractive. So the solution just pours gasoline on the fire.
So the theory goes like this. If the regulators manage to push down the paper price in New York, the price for actual physical metal in places like Shanghai is just going to decouple and shoot for the moon. You'd see this huge gap open up, a massive premium, as everyone scrambles to get their hands on the real thing, draining the physical supply from the exchanges.
So, where does this all end? What's the final verdict? Let's look at what the source predicts for when the markets finally reopen.
The source says that those first few moments of trading on Sunday night are going to be everything. It'll be a massive signal to the world, telling us whether those secret meetings worked or if the panic is still on.
And it even gives us a checklist of things to watch for. First, watch the gap. Does silver open higher or lower? Watch the volume. Is it crazy heavy or super light? Keep an eye on gold and oil. Are they moving up too? And finally, watch bond yields. If they're spiking, that could signal a much wider debt crisis. The source says if all these lights turn green, it means the free market is winning and the situation is spinning out of control.
And finally, the source lays out what it calls an action plan based on this whole theory. For people holding physical silver, it says, be patient, don't sell into a panic spike. For those holding paper silver, like in an ETF, it warns you to check your counterparty risk. Basically, can you be sure the people who say they have your silver actually do? And for anyone new looking to get in, it suggests mining stocks might be a way to get exposure.
And it all comes down to this one final, really provocative idea. It boils this entire complex theory down to a single sentence. The system sold more silver than actually exists, and now the real owners want it back. It leaves you wondering, what happens when a financial system is built on a promise that it might not be able to keep?